Thanks to our friends at The Motley Fool for sponsoring this video. Check out the link below, fool.com/the smattering, to get access to the 10 best stocks to buy right now. Depending on when you bought it or when you started tracking shares of Airbnb, the stock is either way down or way up. You might be trying to figure out, is this time to buy Airbnb? Is there still time to buy? Or maybe is it time to sell? But maybe it's not as cheap as it looks. I'm Jason Hall. This is The Smattering. I got Tyler Crow here with me to talk about it. Tyler?
This is what intrigues me the most about Airbnb over a lot of other companies that I think it gets thrown in with at this time. I think a lot of people are going to call it one of those pandemic growth stocks, unprofitable, whatever. But one of the things that we have seen over the past year is a pretty rapid pivot to profitability, or you could call it the profitability flywheel has spun up for this company. If you look at its operating costs, and that right there is where you're starting to see like the scale, economies of scale start to take place, where the revenue is improving, but we're not seeing as commensurate of a increase in those operating costs, while at the same time maintaining a good growth rate.
If you take a look at its results since it went public, it has consistently had gross margins in the high 70s to low 80% range, finished 2022 with gross margin of about 82%. What we saw in the first year, in all of 2021, its first year as a public company, its operating margins, what's left over after covering all of the operating expenses, not just the costs directly related to goods sold, was very, very negative. In other words, it was spending a lot more to cover operations than it was generating, right? That absolutely flipped at the beginning of in late 2021. But then over the past year, we have consistently seen that operating margin continue to grow to like almost 23% by the end of the year. And as a result, this is a business that went from burning cash to generating an enormous amount of cash, generated over $3.4 billion in free cash flow in 2022, Tyler. But there's a big caveat of an expense that is not a cash-related expense up front, but it kind of is a cash-related expense at some point down the line, right?
Yeah, it's how big is your stock-based comp? And Airbnb is certainly guilty of it, although not as guilty perhaps as others. $930 million in stock-based comp in 2022. If we tally that up against that $3.4 billion number you end up with $2.5 billion in operating cash and very little in capital expenditures. So, 2.5, not as good sounding, but respectable in its own right. Perhaps one would hope that as the business matures, that stock-based comp number becomes a little bit more in line with what we would like.
To unpack all of that again, you have a business, a platform-based business that has proven that it can be a cash-generating business. There's things we like about the platform as users. It continues to expand its market. It continues to grow all around the world, and it's doing that in a profitable way, even within the caveat of that large amount of stock-based compensation. So when we hear a company like Airbnb start to tout a stock buyback plan, they're basically just trying to cancel out the dilution from stock they're issuing as part of their compensation to employees, right? Now, looking at the valuation, if you look at it unadjusted, Tyler, trades for 27 or 28 times free cash flow. But again, we apply that stock-based compensation to it, so free cash flow after stock-based compensation, and it's well above 30 times. Do you think at this valuation, do you think this is a stock that investors should be looking at buying and holding for the long term?
I think at this current valuation, I don't know if I'm ready yet. There's a couple things that still make me nervous. Like if growth were to slow down, 35 times cash flow is a lot of money to pay for a stock. And at the same time, there are some other questions to be raised. Things like they're starting to issue damage insurance for guests and hosts. And, what kind of, insurance costs or underwriting costs. So you start to add those things together. And to me, my conclusion is I'm going to watch this stock very closely. But at current valuations and some of the, I call them yellow flags that still are in the back of my mind, it's one that I'm not ready to buy right now.
I'm going to live a little further out on the risk curve, Tyler, than you are with this one, but that's pretty typical.
That's always the case.
Yeah, right. So I would say, to me, I think that this is probably the kind of company that you maybe want to take a flyer on buying when it looks maybe a little bit more expensive. And if you get those opportunities to add, you'll be glad you did. If you don't and it doesn't perform, you start out with a really small position and you're not taking on as much risk of harm.